Have you ever, found yourself wondering how those massive tech startups, the ones that seem to pop up overnight and just redefine industries, how do they actually get funded? And maybe even more importantly, how do the people doing the funding make their money back? And then some. Well, today we're diving deep into that very question. Welcome to the deep dive. We're continuing our series, The Other Side of the Table, a deep dive into the investor's playbook. Today, we're really focusing on exits and returns, the VC's profit engine. Our mission, really, is to demystify how venture capital firms truly make their money and, the absolutely critical role that successful exits play in their entire profit model. We'll be looking at the specific ways VCs generate returns and how that often fundamentally shapes their whole approach to the startups they back. It's a business unlike many others, and understanding its core mechanics is essential for anyone on either side of the table, really.
Yeah, what's really fascinating here is that the venture capital model, it isn't about steady, predictable revenue at all. It's deeply tied to long-term outcomes, often years down the line, and a very specific, high-stakes portfolio approach. Unlike, say, a traditional business focused on quarterly profits, VCs are playing a completely different game. It's one driven by a few massive successes. So when we examine the core motivation of venture capital firms, it really boils down to seeking exceptionally high rates of return on their investments. And this isn't just like a preference, it's a fundamental necessity for them. Their entire business model inherently involves significant risk. I mean, they're betting on unproven ideas, often with unproven teams, in markets that are just emerging or changing super rapidly. That level of uncertainty just demands a truly massive upside potential.
That sounds incredibly demanding. I mean, if most of their bets don't pay off, why? Why are these target returns so incredibly high? Are we talking realistic targets for like most businesses, or is this really for a very specific type of company?
Oh, it's absolutely for a very specific type of company. Our sources indicate that target returns of 50% or 60% are not uncommon hurdles for VCs to apply to prospective investments. And just to add a bit more precision for you listeners, these aren't just good annual returns. These are often internal rate of return, or IRR, targets. It's a demanding hurdle rate, right? It forces VCs to constantly seek out those truly disruptive fund returning opportunities. This isn't just a wish, it's a necessity. They have to compensate for the overall riskiness of their entire portfolio. And of course, ensure a handsome return for their own investors, the limited partners or LPs.
Okay, so if that's the bar they set, what's the reality behind actually hitting it? Why can't they just spread the risk more broadly, across lots of smaller, maybe safer bets?
Well, there's a study of venture capital portfolios that shows a pretty stark reality. It's something like 7% of the investments account for more than 60% of the profits, while at the same time, a significant chunk, maybe one-third, result in a partial or total loss.
Huh.
This isn't just a statistic. It really embodies what's known as a power law distribution. It means a VC's investment philosophy isn't about picking a whole portfolio of safe bets. Not at all. It's about finding the few companies that can return the entire fund multiple times over. And this fundamentally shapes how they evaluate your business if you're a founder, right from day one. They're often pushing for hypergrowth, market dominance, sometimes over just sustainable incremental profitability. For every 10 companies at VC funds, they kind of know maybe one or two will be wildly successful and several will completely strike out. Your definition of success as a founder might be radically different from theirs. It often is.
That makes perfect sense, actually. Okay, so we've talked about why VCs need these massive returns. Now let's get into the mechanics. Like, how exactly do they structure their business to generate these profits? You mentioned two core revenue streams for a VC firm.
Right. First, there are management fees. These are what the general partners charge, typically as a percentage of the assets under management, or AUM. This isn't really tied to the success of individual investments. It's a fee for managing the overall fund. And this covers the firm's day-to-day operational costs. Everything from salaries to office space and all that extensive due diligence required to vet countless potential investments. It's kind of the steady income that keeps the lights on and the team working no matter how any particular investment performs.
Okay, so those management fees keep the lights on. But the true prize, right? The primary incentive that drives VCs to find and nurture those breakout successes. That's what's called carried interest. This is where the potential for, well, enormous wealth truly lies. Why this particular structure, and what does it mean for how they actually operate day to day?
Yes, exactly. Carried interest is a percentage of the gain on investments. Simple definition, but huge implications. This means VCs get a significant share of the profits from successful investments, but only after the initial capital has been returned to their limited partners. There's usually a hurdle rate too. It's not just an incentive, it explains so much, like why VCs will push you to go big or go home, why they're eager to participate in later funding rounds for their winners, doubling down, and conversely, why they might seem quick to cut ties with struggling companies. It's all about maximizing that carried interest potential across the portfolio. Without it, the entire venture capital model just wouldn't function as it does. It's their ultimate reward for picking and backing those huge successes.
So, given that dynamic where a few investments account for most of the profits, VCs play what's known as the portfolio game.
Hmm.
This sounds fundamental to their strategy. They're not betting everything on one company, even if it looks like the most promising one, right? They're building a diverse portfolio, kind of like a stock fund, but maybe with much higher stakes and longer timelines. How does this portfolio game strategy actually translate into their investment decisions?
Well, it means that an average fund may be investing in, say, 20 startups. They know they only need to hit one of 20 out of the ballpark.
Hmm.
And that single massive success, that one home run, may provide enough gains to earn a solid return on 100% of the fund's investment. It's what you call an asymmetric bet. They're looking for companies that can return the entire fund or even multiple times the fund from just one hit. This isn't just theory, it drives everything. The types of businesses they even consider, the scale of growth they expect, it all stems from this.
Okay, so what does this all mean for you, the entrepreneur, who might be out there seeking VC funding? You're clearly playing a very different game from the investor you're pitching.
Absolutely. It means that while the VC can afford for some investments to fail they expected, actually the founders of those 20 startups are not playing the same portfolio game. For them, it's usually their one big bet. It's their life's work, their primary focus, everything. A founder's success is often pretty binary. Either their venture is a breakout success, or it's a significant personal lost time, capital, dreams, you name it. And this fundamental difference in risk exposure, it creates some really unique dynamics in the relationship, sometimes tension, sometimes alignment.
And this high stakes game brings us right to the crucial concept of exits.
Mm.
For VCs, an exit isn't just a nice to have outcome, it's the entire point of the exercise, isn't it? It's the moment their paper valuation, all those numbers on a spreadsheet, becomes real cash, which crucially triggers that carried interest we talked about. VCs have a unique perspective on exit because that's precisely when their investments truly pay off.
Exactly. And for the entrepreneur, an exit means having the option to cash in, for example, by selling all or part of the equity. Okay. Now, this can take many forms. IPOs are the famous ones, but statistically, acquisitions are far more common and vital. Consider this example. Maybe there's an early $10 million acquisition offer for a young startup. That might sound amazing, and maybe it's very appealing to a seed round angel investor who put in, say, $250,000 early on. For them, that could be a quick 3x or 4x return, a fantastic outcome, allows them to reinvest in their next early stage company.
But for a VC firm, particularly one that just led a Series A round, maybe putting in $3 million for a significant chunk of ownership. That same $10 million offer, probably a hard no. They would likely prefer to hold out for better exit. Why? Because that $10 million offer would yield basically no gain on their investment at that stage, or maybe a tiny one, and it certainly wouldn't be the fun returning hit they need. This just perfectly illustrates the differing motivations, right? Based on investment stage, fund size, and those ambitious return goals. The VC isn't just looking for a good return, they're hunting for an outsized return, one that moves the needle for their entire fund and generates that really significant carried interest.
Okay, so given these motivations, this need for fund returning companies, the laser focus on carried interest, the absolute necessity of significant exits, what should you as an entrepreneur really take away from the VC's perspective, especially when you're navigating this complex landscape, maybe pitching them or working with them post-investment?
Well, first, and this is tough sometimes, many entrepreneurs fail to qualify for venture capital not because their proposals are poor, but because they do not meet the exacting criteria that venture capitalists must use. They need those potential breakout successes, those 10x, or ideally, much more potential returns. So if your business model, no matter how solid or potentially profitable on a smaller scale, isn't structured for that kind of exponential growth and that eventual large-scale exit, it simply won't fit the standard VC playbook. And it's not a judgment on your business necessarily, it's just a mismatch with their specific financial model.
Right. And even once you get funded, the journey isn't just about executing a perfect plan you laid out in the pitch deck, is it? It's not like get money, follow blueprint, step 3, profit and exit. There's a lot of unpredictable territory involved.
Oh, absolutely not. That's a myth. Success, especially in new and growing industries, it almost always follows many detours and unanticipated setbacks. Strategies often have to be altered radically as events unfold. We see this with examples like Gamalink was mentioned in our sources. Their initial product, this high-speed modem for PC communication, it just didn't find buyers. They had to pivot hard. They changed their entire strategy. They didn't hit their initial target, but their flexibility, their willingness to change allowed them to survive and seek a new path towards a different, potentially more successful market. It's just a reminder that even the most meticulous business plans are really just starting points in this fast-moving world.
So there's this profound need for flexibility, for adaptability, and frankly, a realistic outlook from the entrepreneur. You can't just rigidly stick to the original plan if the market is screaming something else at you. This must influence how founders should think about building their teams and their initial products right from the start.
Precisely. While a founder might get grilled on detailed financial projections during a pitch, the true answer to what will actually ship, especially something like software development, is often closer to we really don't know for sure. Because there's just inherent unpredictability in market shifts, technology advancements, customer adoption. The real key becomes agility in decision-making, staying incredibly close to customer feedback, listening hard, and being willing to rapidly iterate. Mistakes shouldn't be like capital crimes. They should be learning opportunities. Analyze quickly, new information incorporated, and then you adjust tactics. This constant iteration, driven by real market signals, becomes far more critical than just adhering religiously to an initial, probably flawed business plan.
And that feels like it ties directly into how you build the business from the very beginning, long before you're even thinking about an exit or what a specific VC might want down the road. How does focusing on those core business metrics early on influence your ability to attract that kind of investment later and achieve those big exits VCs look for?
Indeed, it's foundational. A big mistake many founders make, according to some sources, is trying to jump right into growth before they think about retention. Trying to scale too fast. It's just so much easier to grow a business when you have incredible customer loyalty, when people stick around because they love the product or service. And then you're able to throw gasoline on that fire, as the saying goes. Use investment to scale something that's already working and retaining users. Otherwise, if you scale too early without that loyalty, you can have massive churn. Customers leaving almost as fast as you acquire them, and it just becomes incredibly hard to profitably grow. Focusing on building that foundational loyalty first ensures that when you do seek growth capital, you have a solid, defensible base. And actually, this strong foundation built on customer retention is a key indicator VCs look for. It signals a business with sustainable, exponential growth potential. It makes your company far more attractive for those later, larger rounds of investment that ultimately fuel the journey towards those critical exits.
Okay, let's try to wrap this up. To recap what we've explored today, we've learned that VCs are driven by, well, a profound need for outsized returns, often aiming for those high IRR targets, 50%, 60%, or even more, mainly to compensate for the inherent risk in their investments. They operate on a portfolio game strategy where a small handful of breakout successes, those home runs from successful exits like acquisitions or IPOs, are what ultimately make the entire fund profitable. And this strategic imperative, it differs significantly from the single bet game most founders play with their own ventures, creating a really distinct set of priorities. And that leaves us with a critical question for you, our listener, to think about. Considering that VCs operate on this portfolio basis, always aiming for those huge fund returning hits, while you as a founder are typically pouring everything into your singular venture, your one big shot. How does this fundamental difference in their profit engine, their perspective on risk, how does that shape the dynamics of the relationship between a VC and a startup? And think beyond just the initial investment check. How might these differing perspectives influence everything? Strategic pivots, hiring decisions, maybe even the ultimate timeline for your company's growth. What specific questions might you ask a potential investor? Not just about their money, obviously, but about their expectations, their strategic vision for your company's future to make sure your goals are genuinely aligned. Something to ponder.